Alright guys, welcome to this video. Today we're going to decide and understand how to fix your credit. What we're going to do is we're going to take a hard look at your credit. We're going to understand the things that are affecting your credit. This is more of a part 2 series of the first video. So if you haven't watched this video yet, the first one, go ahead and watch that right now. So what we're going to cover today is we're going to understand how to fix your credit. We're going to understand how getting on a new credit helps that. We're going to look at the credit utilization, the total percentage versus the actual credit, how your payment history, debt collections, the debt collection cycle, and your current spend. We're going to look at how all these factors affect your credit. So let's just jump right in. Alright, now let's start right here, your credit report. Now just go ahead and Google get my credit report or credit report and you'll find a ton of tools to understand your current credit. Go ahead and fill in your details and look at your credit report. So it's usually split between your overall expenses and your overall credit, which is your credit card expenses plus any kind of mortgage or loan you've got on any of your properties, maybe a car or a smartphone, anything you've purchased, right? Now what we have to understand is there are two types of credit. One is the bad type of credit and the good type of credit. So let's say you borrow money to purchase a home at a very low interest rate, maybe 3, 4, 5, 6%. Now that would be considered good credit because you're actually borrowing money to pay for a home which appreciates in value. Now the counter side is bad credit. What you're seeing here is typically very large expenses or even expenses that you can't truly afford on a day-to-day basis that you're buying on credit because it's available to you. Now, this has to increase, but this has to stop. Now, what you'll also notice in these images is that as you keep on fixing your debt, what happens is you have the ability to acquire more assets by saving more or by investing more. So over time you're going to see a better return. Now everything has a small beginning, especially if you're just starting out, but if you've already cleared some of your debt and you're at a position where your high interest debt is cleared off, you're managing your credit cards better, then you can start to look at better savings. And when you start saving, you can also look at investment opportunities that can bring you higher growth. Now one thing is that you can start off small. Let's say looking at debt at the smallest level, which is, let's say you have debt which is a few percent, maybe below 10%. You can go ahead and start clearing that. But what's really recommended is that you look at your high interest debt first and then you go ahead and pay that off. So what you have left is just interest debt, which is very low interest. So you can go ahead and pay that off over time and make sure you pay it off by being disciplined, by managing your expenses, and by being regular with your payments. Alright, now let's come back to our first screen here and let's understand what we're going to look at today. So today we're going to look at new credit. Now the reason we're talking about new credit is that let's say you have a credit limit of $10,000, right? What the banks look at is they look at your overall credit utilization, which means if you have spent $2,000 out of $10,000, then your credit utilization is 20%. But let's say you have a credit limit of $100,000 and you spend $2,000, then now your credit utilization is only 2%. So to banks, your credit utilization is not determined based on what you actually spend, which is the actual number, but actually the total percentage out of your credit utilization, because the bank has a lot of customers, credit unions and even credit bureaus look at a lot of customers' data and they determine it based on the percentage. So let's say if you have a $10,000 credit limit and you are over maybe 70, 80, 90%, that is a red flag. So what you can actually do is, it's not a really recommended method, but you can go ahead and get new credit, which means apply for a new credit card and see if you're eligible for a credit card based on your current scenario, based on your payment history, based on your current credit score. Now, once you get a new credit card, what you can do is you can put some of your spending on the new credit card and balance it off with the old ones, or you can apply for 2 or 3 credit cards and balance off your credit on the old ones and the new ones, and make sure you don't apply for a lot of credit cards very very frequently, because that also affects your credit. I guess the typical rule is 5 credit cards in 24 months. But what you can do is you can look at this from a very long-term perspective, and you can apply for maybe 2 to 3 credit cards within the next 14 to 16 months, and start balancing the debt utilization or credit utilization that you have on each card, on different cards, and slowly start to pay off the ones that are of highest interest. What you can also do is look at getting credit cards of a lower interest rate, but typically every credit card has a higher interest rate. So some people have actually gone ahead and taken a personal loan, gone off and paid off the credit card and closed the credit card completely because they're not able to maintain that discipline. So this also depends on how much discipline you have. Right, so now that you have some kind of discipline, you've managed to pay off your credit cards and manage all your credit in 1 or 2 cards or maybe multiple cards, thereby to not cross your total, or let's say not cross over 60% of your credit utilization, you can start to look at a better credit score. So now let's understand how payment history. So this is actually a factor that affects about 35% of your credit score. What happens here is they look at whether you've defaulted in your payments, and anytime if you have, especially if your default is more than 30 days, more than 60 days, more than 90 days, then that's going to be a super red flag on your credit statement. And now that gets reflected and makes your credit score look bad, which then reduces your credit score, which then lets other banks know that you can't be trusted with debt. So now that you're solving your debt problem by acquiring new credit cards, by managing your expenses, not crossing maybe 50-60% of your credit utilization, and building that discipline, now you're in a better position. So you've also in this cycle learned how to pay off your cards frequently. Now, looking at payment history, also look at your low interest ones. Let's say any kind of loans you have which are low interest. Make sure you make payments on your mortgage, payments on your car, any kind of insurance payments that you have. But also make sure to not spend more than you can currently afford, because despite credit being available to you, it doesn't mean that you should go ahead and spend. In fact, what you can do is go ahead and put expenses on your card that you would normally spend if you were to spend, say, from a debit card, or just you can use it like your debit card. And what you can do is use the points that you accrue for flight tickets and hotels and enjoy that lifestyle a bit as well. So that's when your current spend analysis comes into play. Let's say you open your credit statement today and take a look at your most expensive spends. Now, I'm not asking you to look at your entire income and expenses here, because that you would have done had you followed the previous video. But I'm saying look at your current expenses on your credit card. Take a look at the topmost expenses, which are your most expensive ones, and see if they were really necessary. Maybe this is a discipline problem and you're going to have to solve that by managing it right. Now, typically what happens is when you're overspending and you're not paying that back regularly, that does give you a red flag. And let's say you're late on your payments by 30 days, 90 days, or even 150 days, the banks sell your debt off to a debt collection agency, and the debt collection agency could probably buy your debt at a very low amount compared to your total overall debt, and the profit they make on that debt is anything they're able to get from you. So typically after this, you'll start seeing a lot of calls. Might not be directly from the bank, could be from a debt collection agency. This agency is going to go ahead and look at how much debt you have, and typically you can also bargain with this agency because they have not really paid a lot of money to get that debt or to buy that debt from you. So now you owe them the money. If you can settle on an amount then you can go ahead and pay off that debt. So that's how debt collection agencies work, and typically banks write off that debt in about 150 days because they don't think that they can actually get that money back from you. I think we have to spend a little more time on understanding current spend. Now, current spend, let's first start with your overall expenses. Your overall expenses, I would say for a lot of people, the biggest expense would be their rent, post which their car, maybe their insurance, or any kind of spending that they do, right? And some months you might have more spend compared to other months, maybe on the holidays, or maybe you have to extend a certain membership, right? So that those spends can be a little higher, but I'm looking at the amount you spend on a regular basis. You really have to look at the way in which you're spending and the mindset with which you're spending. Are you spending on things that you don't really need? And if you can afford it, do you really have to take that money and go ahead and spend it on that particular thing? Because once again, we can look at your credit, the amount you're spending on a day-to-day basis. Go ahead and pay off the debt and pay off the credit that you borrowed, which means the debt that you actually borrowed, and start to look at an investment plan that can actually grow your money over time. When this happens, when you start to consolidate all your debt, which is maybe your home or your credit cards or any kind of subscriptions that you have that maybe you're planning to close down, then you can say that your credit has been fixed. Now, the challenge here is that this might not be a short-term solution. This might be a long plan, maybe even a 3, 5, or a 10-year plan that you have to look at to go ahead and completely fix your credit. But discipline will pay off, and your efforts will also teach you how to understand money and maybe put forward money for a better investment plan. So let's look at your actionables for now. First step, let's look at your current credit. Second thing, understand what is the overall utilization compared to the available credit limit you have. And third, correct your payment history by developing the discipline to pay back your credit often. Thank you for watching this video. Go ahead and subscribe to this channel.